Welcome to the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Hey everybody, welcome to episode 42 of Teaching Tax Flow, the podcast. Today we're going to jump right into a great topic, as always, Mortgage Prep 101. And before we do that, let's take a quick moment and thank our sponsor. This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with a huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these tax benefits. To take advantage of a special TTF community discount, go to www.repstracker.com/affiliate/teachingtaxflow and use the code IFG. You can look in our show notes or email us at hello@teachingtaxflow.com. Welcome, everybody, back to the Teaching Tax Flow podcast. You may recognize this guest who's going to join us today all the way back from episode 6, believe it or not. That's November of last year. So we're throwing the ball way back into history. Brenna Carls, how are we doing? The mortgage shop. What's up?
Was that long ago? It does not feel that long ago. Wow, that's crazy.
Wait, time goes by fast when you're having fun and you're making money / saving money with taxes. So We introduced you first. Of course, my co-host, the stunning young chap, better known as Chris Picuro. How are we, buddy?
John, did you go to happy hour?
No, not yet. I mean, everybody's happy around this joint.
We're never going to put this on YouTube. After that introduction, I don't want anybody disappointed. My
We'll set up here.
Hey, it's all about setting expectations. And today, we're going to set some good expectations with Mortgage Prep 101, as we really focus in a little bit on that, first-time home buyer, and maybe talk about, Brenna, I know you actually made a great post on y'all's Facebook group. I heard somebody had commented on there. It might have been me. I don't know. Not to toot my own horn. About the best ways to completely muck up the process for you guys. So I know you guys are both in Tennessee. I'm up here in Michigan, so I'm not chiseling any icicles off my beard yet. But did you guys know that tomorrow, completely unrelated, or actually today, is National Climb a Mountain Day?
Oh, I
know that. So I expect both of you to get out and climb some hills. But let's get back on topic. So Brenna, kind of walk us through this a little bit. So obviously you guys are really, really good at what you do. You see all types of clients all around the country, all types of situations. Maybe start us off with, how does that process really look, a very condensed version of it, for somebody who's looking for that first time property, whether it's a primary or an investment property? What does that look like?
Yeah, I mean, if you were looking at primary first, it's somebody that you could have owned a primary residence before. Maybe you rent now. I'll give you an example. Like my husband and I owned a property, and then back in the day, I sold it to pay off my student loans, and then we rented a property for a while from a builder we knew, and then it was just last year that we stopped renting and bought our new primary residence. So you can go from, one primary residence, then renting to another primary residence. You don't have to be like that first time home buyer, what people hear, and I'll kind of go into what that means. But it's just like if you're renting and then you're ready to take that next step, maybe you have a little bit of down payment, maybe you have a family member that's wanting to gift you those funds for your down payment to get a primary residence. You can do that and be pretty much the same or better at your monthly payment than you would be paying somebody in rent. And people are like, well, why would I want to pay the same if I have to move all of my stuff? Well, it's because your property is hopefully appreciating. So most areas that we're in, your property will be appreciating. You own that. You're paying on that mortgage as opposed to paying somebody else's mortgage on that apartment that you're renting or property that you're renting. And your money's actually going towards something, going towards that investment to own a primary residence. It's the same with investments and second homes as well. Maybe your point isn't to pay money, like pay for your mortgage for a primary residence, but it's also for income producing, for appreciation as well, because people need to look at that when they're investing in properties. So it's pretty much the same thing, pretty much all documentation, same documentation required. It's just what the borrower's primary goal is at that time.
Awesome. And you mentioned documentation, right? So we're not talking about passports and work visas here. And this is where we can pick Chris Pick's brain a little bit, right? So really the mortgage process and taxes go hand in hand, right? They're basically married at the hip. So I don't know, Chris, if you wanted to jump in and talk maybe a little bit about how you in your practice and your life have kind of helped support individuals getting up to the closing table. And then Brenna, obviously feel free to chime in and, tell us how people have completely messed this up or what really looks best in that process.
We know that in teaching tax flow, one of our 3 laws is that tax agencies are your involuntary business partner. Tax laws are written to encourage and discourage certain behavior, and they're definitely encouraged to encourage home ownership. If you think about this, if you own a property, you are allowed to deduct your mortgage interest and property taxes. Instead of when you pay rent, you can't. So you're using pre-tax dollars when you own a home, and you're using after-tax dollars when you're not. And if you're at a marginal tax rate of, let's say, 25%, that's a significant difference. We also know about the importance of tax-free income and growth, our goal diagnosis. And we did a podcast that was very popular about how a married couple can make $500,000 tax-free. And that podcast was about the Section 121 exclusion. So what Brenna mentioned is instead of paying someone else's mortgage down or putting money in their pocket, if you're building equity within your property, for the 99% of the people out there, when they sell that property and it was their primary residence, that is tax-free. So you're using pre-tax dollars to make for many of your expenses related to home ownership. Yet when you pull the money out of it, you don't pay any tax. It's the exact opposite of like a 401k plan in a way. There's a lot of benefits to home ownership from a financial standpoint, let alone pride and, just having a nice asset, having that security of owning a property. So the tax benefits are right there. And really, if you're, a lot of times what you're paying in rent is going to be more than what you're going to pay on a mortgage payment. But the challenge when you mentioned of helping clients and more people in the teaching tax flow ecosystem, getting them to the point where, one, they understand what home ownership looks like and what they can afford. It's really, really important that they go through the pre-approval process, which is different than pre-qualified. I'd love Brenna to touch on that because those are terms the mortgage shop does an amazing job of explaining that. But because you want to make sure you understand what you can afford before you start shopping for a property.
And Brett, I'm sure your eyes just lit up when you heard that comment. So yeah, walk us through that a little bit on your end. So kind of piggybacking off what Chris was mentioning there, and really just getting things, in a sense, getting things in order, right? So what does it look like on the lender side of things?
Yeah. So if you guys are like trying to frantically write down what we're saying, don't, because I go over this, everything in Mortgage Prep 101 every Wednesday at 11 a.m. Eastern. They'll put the links in the description of the podcast for you guys to join that. And I'll go over all of this in detail. You won't have to memorize any of it. But pre-qualification versus pre-approval. Pre-qualification is basically worth the paper that it's written on. It's based off of what you state your income is. It's based off of what you state your assets are. We can do what's called a soft credit pool, which isn't a hard credit pool, which may not pull all of your debts in. So it's basically stated debt. And I do not like doing those usually for primary residences or full doc investment properties, which means going off your debt to income ratio, because I'm an investor as well. And the last thing I want you to do is go under contract for property and then realize you actually don't qualify. So we do what's called a true pre-approval, not a pre-qualification, a pre-approval. We run your credit, we verify assets, we manually underwrite your income to know that, like, if we give you that letter, it's gold, you're done, you're good, unless you go out and buy a Ferrari without us knowing, that mortgage process is going to be very seamless for you.
Let me ask this question a lot. I get this sometimes and I wish I knew what I knew when I bought my first home. I didn't know what the heck I was doing. Yet when your credit is pulled, first of all, what are some maybe 2 or 3 tips? And again, I strongly encourage anyone listening to go to the mortgage prep course. But what are 2 or 3 tips that they should know about their credit report before they apply? And how long is that credit report valid in that qualification and potential closing process?
Yeah, so a lot of people don't, go to Credit Karma. That's not accurate. Your credit score, the credit bureaus and the credit scores that we pull are different than credit card companies pull, are different than what Credit Karma shows, and what are different than actually auto loans pull. You may have like an 812 credit score on Credit Karma, but your credit score actually be like 735 or 720 with a normal hard credit pull from the 3 credit bureaus, which are Experian, Equifax, and TransUnion. We take the middle number out of all of those. So if like one's 800, one's 798, and one's 812, the middle number would be 800. So your credit score would be essentially 800 for that loan. So just know that that is not an accurate credit score. If you want an accurate credit score, obviously you can ask your loan originator that's pulling it, or go to freecreditreport.com. You do get 1 free credit report per year. Don't do high balances. If you are trying to increase your credit, don't max out your credit cards. If that's your number one goal, I would say get a small credit card, maybe with like $1,000 limit or something like that. Put groceries on it. Pay it down to 25% of the max amount per month, and keep a balance on it, because guess what? Credit cards don't make money unless you pay interest on it. So it looks better for you to have a little bit of a balance on there. So the credit card company's winning, your credit score is going up, and you're winning, everybody's winning. So just keep that in mind.
That's a great tip, because your credit score can greatly affect not only what you're eligible for, but your credit, or rather your interest rate, which ultimately affects what you can purchase.
Yeah. So interest rate also goes off of credit score. So your debt to income ratio may be a little tight. If you have a lower credit score, then it may determine if you're going to be able to buy that property in your price range or not. So you just definitely want to keep a check on that. If you want any tips or tricks of what to do to increase your credit score, we can also kind of help you with that through the mortgage process. We can't just pull your credit for no reason. You do have to be applying for a loan, but we can look at your credit report and kind of give you advice on what to pay off first to increase your credit score.
Excellent advice. And so here's a question, actually, again, for both of you. Say somebody was self-employed, and they just love writing stuff off, right? Every possible thing I know both of you are probably like, oh geez, not this clown. Writing everything off, right? And they say, oh, well, when the time comes for me to buy a home, I'll be fine. Like, things are going to be better in the future, right? Everybody thinks that, unless you're a negative Nancy and you think things are going to be worse, then you got bigger problems. But for the most part, how does that really affect things down the road? So say you had Johnny Appleseed over here 1 year. He's works for himself, does fairly well, but takes every single, he's, again, writing off everything, every deduction, pays very minimal in tax. And then 3 years later, goes to start a family, realize he needs to purchase a home. The apartment or condo he's in is no longer suited for him. How does that look? So I imagine there's some big challenges in that process.
So yeah, we're all about trying to utilize things on your tax return to increase your income or decrease the amount you owe to the IRS, right? And there's a happy medium with that. You can claim things as expenses and things like that if you're self-employed on your tax return. But if you do that, keep in mind that it will decrease what your income is showing. So I get a lot of clients that are self-employed and be like, I made $800,000 last year. And I'm like, well, I feel like Jerry Springer. I'm like, well, the note says that that's a lie, because after I do your income analysis, you're making like $50,000 a year, which is crazy. That's a big example. But if you claim a lot of stuff on your tax returns and expenses, and amortization, casualty loss, things like that, it decreases what your actual income is. And people are like, well, how do I know that? Well, you can, come to your loan originator if they're proficient in tax returns, which I am, and we can do that income analysis for you to let you know what your true self-employed income is. If you're W-2, you really don't have to worry about it unless you do have a side hustle that's a self-employed job. But if you're W-2, we take the gross of that, But if it's self-employed, then we have to take into consideration what you've claimed on your taxes, so you don't have to pay much to the IRS. You can't have your cake and eat it too. You're going to get hit somewhere, whether it be owing to the IRS or not showing enough income on your tax return to qualify for that mortgage.
Mm-hmm. And that's where I'm going to make the assumption where it's a much better relationship going to an originator such as yourself versus going, I mean, nothing against them, but like straight to a bank, right? Like it's, my experience with them is they're very binary. It's either you are or you aren't. There's not
there's no
gray area, but yeah, there's no in between. That's a great way to put it. So,
I mean, I used to work for a bank, but the thing is, before I got to the bank, I interned at a mortgage company, and the mortgage company was actually ran by a CPA. So I learned taxes very well early on in my career. I will preface there's very few, maybe like 1% to 2% at a bank that knows what they are doing. I fortunately was able to be in that because I was taught well. But bank loan originators aren't, they don't have to be licensed. They don't have to pass tests. They don't have to, know really what they're doing first. Versus us, we have to be licensed. We have to take that test. We know what tax returns are. Any good loan originator should know how to read tax returns. I see so many, and this is like a different topic, but just giving accelerated depreciation as an example on rental income. I see so many people, loan originators in these groups like, hey, they're not qualifying because they claimed accelerated depreciation. I'm like, well, you can add that back in. You're supposed to add that back in. And it really could make or break your deal if you don't work with a loan originator that knows how to read and delve into tax returns to do that income analysis for you.
That's a question I have coming from the tax world. And we really do try to talk to our clients, from the first time home. Typically a first time home buyer is not necessarily going to have a lot of rental properties, but Brenna did touch on that. When, let's say someone's self-employed, just straight Schedule C, they're reporting their income on Schedule C, and let's say they bought a new vehicle and they took a big depreciation deduction on the vehicle, or they take the home office deduction. What type of expenses can be added back to your income when you're considering your debt to income ratios? For someone that's self-employed, obviously the W-2 people, from a tax perspective, that's not a good situation because you don't get any deductions, and you're taking tax on your gross income. But from a mortgage standpoint, it's apparently safer. But from someone self-employed, what can they add back, and what could be when they reconstruct their income?
Yeah, so if you're doing Schedule C, remember you do have to have a 2 years of your tax returns to qualify for that income. You can add back in any amortization, casualty loss, depreciation. And then if you have a one-time extraordinary expense on your Schedule C, that means you didn't claim it the year before. I see so many tax returns that says it's one-time expense, and it's like, I don't know, this like ticketing sales. And then the next year it says one-time expense, ticketing sales. Well, that's not a one-time expense. Now we have to count that into your expenses, which takes away from your income. So just keep that in mind. If it is true one-time expense, like you did buy a car and you wrote it off and that's your one-time expense, that's fine, but it will take out from your total income because it will add to your expenses for that year. But we don't have to count it, if it's outside of that realm for the 1 year. If it's on there for 2 years, it's the same thing. We're counting it against your income.
And do you recommend someone put on their one-time expense, or is it something that they explain with maybe a letter or something like that after the fact, from their...
I would prefer them to put on their one-time expense, because then I would ask them, because if not, I'd have to come to you if they're their CPA and be like, hey, I need a letter from you saying that this was a one-time expense. Otherwise, it's going to be counted as a true expense and we'll deduct their income. So I would love for it to say one-time expense. If it's a true one-time expense, I don't like to see 2 years tax returns. The same CPA is like one-time expense, ticketing sales, 2023 ticketing sales. I'm like, no, that's the same expense. Like, can't do a one-time expense on that.
That's something to consider, that 2-year rule where, that income is for it to count, it needs to be on the tax return. What about someone that, and I know we've only got a couple more minutes left here, but, especially people that are self-employed and their business is growing and they might elect to be taxed as an S corporation. If it's the same LLC and they just changed how they're taxed, do they have to restart that 2-year clock, or can they use the last 2 years?
No, they don't have to start that 2-year clock. And again, you need to work with somebody, a loan originator that knows tax returns and knows what they're doing, because self-employed is self-employed, whether you file it on a Schedule C or an S Corp or a C Corp partnership, anything like that. We just have to average it out. So we do a different calculation for Schedule C than an S Corp or a partnership, things like that. And then we just take both of those calculations, put it together and average those two incomes out divided by like 24 to get that average monthly income. So you don't have to. You just, if you want to make that switch, try not to keep making that switch. Make it because it's really beneficial for you in the state that you're in for your company.
Right. And any final one or two tips or tricks? I know, sometimes someone's considering purchasing a home. Maybe they're considering a job change and they might just want to hold off on that job change if they're in the middle of a transaction. Maybe I'm just overthinking it, but any one or two things our listeners could take away in preparation to coming to the Mortgage Prep 101. And I would say, even if you have a mortgage, if you're thinking about buying another house or relocating, there's nothing wrong with preparing yourself because you want to get the best terms possible.
Couple tips, and I'll try to go through them really fast, and I'll delve into it more on another episode or in Mortgage Prep 101. But if you are wanting to, let's say you have cash under your mattress and you want to use that as part of your down payment, you need to let any type of income or any type of assets that you're wanting to deposit that you can't paper trail, you want to deposit that in there and let it season, which means sit for 60 days at least, so it won't show as a large deposit. If it shows as a large deposit and you can't show a paper trail, you will not be able to use that as a down payment for closing costs or for your down payment. Second, you don't have to be a first-time home buyer to do an FHA loan. A lot of people think it means first-time home buyer. It means Fair Housing Act. It's a government loan. However, you can't have two FHA loans at the same time. You can have one. Then you can refinance out of that if you want to. Go get another one. It's not one and done. That's not what FHA means. So you can do multiple FHAs. You just can't have more than one at the same time. Don't go out and quit your job during the loan process. If you do that to me, I will find you. I'm kidding, kind of. Not really. But yeah.
She's not kidding at all, you guys. She is not joking at all. So
I have ways. I have high connections I can find. No, I'm kidding.
Well, you'll have all their valuable information before they get to that point, right? You will
be
find
taken movie by a 5-foot mortgage person because they quit their job and went to Spain. And that's it. Those are my facts. And then you can make income from your primary residence is my last fact, and I'll leave that as a cliffhanger for you guys to learn more about mortgage prep or on another episode of how you can do that and become an investor and from a first-time home buyer to an investor.
Awesome. Well, if that's space interest peaks, you've got bigger problems. Again, you got some stuff going on. But Brenna, thank you for jumping back on with us. It's been a while. I know we talk to you very often because we're always picking your brain, and you and Chris.
All the time you don't want to hear from me, but yes, you talk to me.
Oh, what are you talking about? I talk to Chris every day. You think I want to hear from his mug all the time? No, not at all. But again, thank you for joining us on this. As Brenna had mentioned, we'll definitely drop the link below in the show notes for this one. For Mortgage Prep. And until next time, everybody enjoy, send over those questions, and we'll see everybody soon. Hey everybody, John Trapolsky from the Teaching Tax Flow team still here. Thank you, Brenna Carls from the Mortgage Shop, for joining us on this show, jumping into a lot of the tips, tricks, and really just looking at the whole process from your point of view as someone who is in this all day long. So your insight is very valuable to ourselves as well as our listeners. So thank you for your time, knowledge, and actually, if you haven't had a chance, anyone who's listened to this, be sure to go on social media, multiple channels, check out The Mortgage Shop. Great information on there from Brenna and her team. But even so, we did drop the link in the show notes for her Mortgage Prep 101, which you can sign up for. I believe it's a quick 45 minutes-ish. A Zoom meeting that they do once a week. So we urge you to check that out, as well as hop on to defeatingtaxes.com. That's our private Facebook group here at Teaching Tax Flow. Send over any questions you might have, any topic ideas. I know Brenna is very active on there as well too. So if you did have any questions for her, feel free to drop those into the group. So until next time, thank you for listening.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.